Hello, ladies and gentlemen. And as we can see, the week actually closed quite strong at 40. So we are in a risk-off period. Never forget that the score actually reflects the relative strength between equities and fixed income. So now it is a time for equities. And as we can see, the daily model is in SPY, and as is the monthly model, while the weekly model is still in TLT, but it is very, very close to giving a buy signal. As you can see, on Friday it actually closed at minus 1.28, so definitely next week, unless we have a disaster, we will be 100% in risk on. The only problem here that I can see is that we are very close to the upper level in deviations, which comes in around 300. So we really do not want to be long much above 300, because even though this red line is slowly rising, there will be better opportunities to buy it on dips, much like it happened here in this period. I fully expect the market to test this 300 level in SPY and then come off just to basically annoy everyone, and set a lower low, stop everyone out, and then go again. I fully believe that the model is rational and showing a good relationship between the fixed income and equities. It is now definitely a risk-on period where equities are going to be better to hold, but that doesn't mean that they will go up very much. It just could mean that fixed income is going to be weaker than equities. If we look at the forward earnings, we are right on top the 17 times line. It has never really paid to be long above the 17 times Blue Angel. It is not something that sensible people do. There is no point. So basically what we're saying, it's a trading market. The market will get to time 17, maybe exceed it slightly, but eventually it's going to come back to the 16.5, 16.7 times line, and that is where you buy it again for a move back up. The slope of the 17 times line is quite flat, so believe me, it's going to take quite some time to exceed that 3000 level with any conviction. The 2-year is very interesting because it broke this 178, 179 level, and it went straight through to the Bollinger Band around 188. To me, this indicates a market which will now trade 180, 188, and then probably break higher towards the 205 area. To me, that is going to be the most wonderful long opportunity. I still think that we have a very strong probability that we close the year or sometime during next year around the 130 level. I'm just not a believer that the United States can escape a recession if every other country goes into one. So I will give the 2-year the benefit of the doubt. I intend to increase my positioning substantially in the 2-year note. Probably one of the best risk rewards that I see out there in the medium to long term. But that is still to come. In the next couple of weeks, I think the danger is for higher yields, simply because we have Powell next week, and he's bound to be not as bullish as the market would like him to be, simply to spite Trump, I would have thought. And also we have some inflation data, which is unlikely to be as dovish as the market expects. As far as the relationship between bunds and 10-year notes is concerned, I'm still looking for the market. I'm hoping for the market to touch this minus 244, 245 level, where I think there is a wonderful risk-reward play to be taken on the upside. That will match with DXY, and why I think DXY is more likely to break down than up. but I will take it either way. I just think this is a wonderful swing level. Be aware of minus 244, 245, and look intensely at what the market does if it reaches that level. That will tell you a lot about the movement of both fixed income and the US dollar over the foreseeable future. The fives suffered less than the twos, but to me it's pretty obvious that at some stage we will test this 187 level and go to this 192, 193 level. What happens there, I think we remain in a bit of a range with not 193 above, but I really would not be surprised over the course of several next week that we go and test the upside towards this 213 level, which is so important. I don't think we break 213 for quite some time, but I would not be surprised to see movement there. And that is why I think we are getting the risk-on signals that we are, not because the equities are going to go too far on the upside, but because they are going to remain much better bid than probably twos, fives and tens. And here we have the tens, much better bid, but we do have room over the next week or so up to 215, and then this very, very pivotal area around the 225 to 230 area. I don't think we exceed it, but there is a distinct possibility that we go and test it. Eventually we will come off quite strongly, but that is the danger, and again, as I've said, that is why probably equities on dips are probably a better buy until we get to this area, when I would probably switch to fixed income, because I think there's much better opportunities there. Last week I made you aware of this 132.08 level in TLT. We managed to close just above it, but you can see we've had 3 drives up, so unless next week we do something fantastic, I think that the odds are that we break this 132.08 level and we head towards this 127.5 level, which is so important to me. This is where all the support is going to be over the next course of next couple of weeks. I expect it there, and there I think it's going to be probably a wonderful opportunity to get some calls and watch it go towards the 140 level. But that is why I'm very cautious about fixed income for the next, I don't know, 3-4 weeks, and I think probably the better opportunities are going to be in equities. Well, equities on Friday were actually a typical risk-on kind of trade. They cheapened the market together with bonds. As soon as bonds and the general fixed income stopped going down, they ramped the equities up. You can see the Bollinger Bands around 3,000 in the dailies. Really, they might test it a couple of times next week, but anything over 3,000 is going to be very, very hard to maintain, and I fully expect a move at some stage down towards the 29.65 area, where this decent support will lie, and probably by the time this red line rises there, this 29.40 level, which has been very important, I expect that one to be touched as well. Have a look at the weekly as well. 3002, okay, there'll probably be 3008, 3010 next week when the Bollinger Band opens, but this is all we're talking about. You can see how very rarely does the market spike and stay above the weekly Bollinger Band. It's just so unlikely to do it, especially since deviations is there, and that's a different type of Bollinger Band, which is even tougher to maintain a break of. So every time you see anything with a 3 big figure, you are basically out. I've also again enlarged the monthly 3022 for the Bollingers. It does spike it sometimes, but it never stays above it, so which tells you there will be better opportunities. And when it does spike it, the move down is quite violent, and it tends to go to one of these very important moving averages and probably through it. Very rarely does it not go down to, for example, this blue one, which the month after will be around 28.50, something like that. But it's a nasty move when it spikes the top of the Bollinger Band. So please use caution above 3,000. If you have to stay long, switch it into calls. It just will not pay to be long of outrights. As far as volatility is concerned, I told you about the gap fill that there was last week. We've achieved it. Beautiful gap fill. And now these levels are going to be all important. You have these very important levels around 1180 to 12, which are very difficult for the market to stay below. You can see it hasn't stayed below there for a very long time. Not even in 2018, while the market was rising, did it stay below there for any length of time. It is unlikely that the market will manage it now, and I would have thought that anything you buy with a 12 big figure, you will be able to sell with a 14.5 to 15 big figure without any problem whatsoever. That actually gives me quite good confidence to sell anything above 3,000 in the ES or SPX without any problems. The DAX, as I said last week, 12,600 and something, 50-ish, you get out. That was the top of the Bollinger Band. Basically, now 12,420, 4,030 is very pivotal. You can see how it behaves. While it's above it, it's still bullish, but I expect the market to do something like this, basically wedging higher without very much conviction, still being bounded by 12,430, but really I'm not very bullish, and I'm not really looking for acceleration in the DAX. I'm quite happy to trade it, buying it down here, selling it, anything around these level, 12,750, something like that. More than happy to basically mirror my trading in the SPX. As far as the dollar is concerned, well, DXY is beginning to really match Euro USD, which is the kind of confluence you would expect at very important junctures. To me, the market is now bound by 111.0809 and 114.84. Now, these levels I've not drawn in now. They have been in here for years. To me, these levels are all important. If the market breaks, anytime it breaks 111.10, I will go short, simply because I expect momentum to carry it at least 1%. But really what I'm looking for is the day that it breaks 114.85. That is the day that I will know that it pays to favor being short of DXY and being long of puts in DXY or calls in Euro USD, whichever way round you want to play it. I still think that the administration will want to engineer a lower dollar sometimes towards the end of this year, and that is why I'm happy to be long of long-term volatility and long-term puts on the dollar. Now, I might be completely wrong, but if I am going to make some money on being short below 111.10. On a weekly chart, gold did more or less exactly what I said it would. It did go slightly higher than I thought, and it didn't get down to 113.69, but I fully expect it to trade there this week, and that will be a good level to get some calls in, simply because I think now the market is doing a decent amount of work below, and at some stage is going to break this 114.58 on a closing basis. That should coincide with a weaker dollar and a weaker and lower real interest rates, i.e. stronger fixed income. Since I don't think that's going to happen for quite some time, I am quite prepared to wait for this 113.69 level and then possibly this 113.25 level. I think it's more likely to go down over the next 2 or 3 weeks than it is to keep on going straight up. I've taken some profits on my long gold positions, but I still want to get the bulk of my new positioning in around this 113.25. I'll start 113.69, but really this 113.25 to 113.10 is where I would really like to see it. My biases for next week, I've given you here all the levels. 188 is now decent resistance to the 2-year note. If we break through there, we are probably likely to touch 2 and 205. But 180 is now strong support. I do not expect it to go below 180. You have the 5s and the 10s, exactly what I told you in the video, and TLT, remind you, below 132.07. It could go some way, and that is basically because I expect TLT to do this, that I think the 5 years and the 10 years and the 2s to a lesser extent are going to do what I keep on telling you. 245 against the 10-year note in the bonds is the only thing I'm looking for, and that should give me a very good clue about what is going to go on in the 5s and 10s. SPX, these are your monthly Bollinger Bands. I really think it's not likely to exceed it by very much. Please switch into calls. There is absolutely no reason to stay long above 17 times forward earnings. There is much more danger there than anything good that can happen. Not much has changed in NQ or RUT. I still see the same potentials, but the gap fill was achieved. 1175 to 12. I would basically go to 1200 here on percentages. I really wouldn't wait for 1175. That is where you want to get long, and anything you buy there, I'm sure you'll be able to sell with a 14 big figure on it. European equities, I told you, this was what I put down last week, 12,600, 700 and out. Exactly what I got. I squared up my DAX. I don't want to know about it anymore. 12,420 is now really the big pivot point, as I showed you in the chart of the DAX. Not much has changed in my conviction, long-term conviction of DXY. I mean, I knew the market was going to come back. It's probably come back slightly more than I thought it would, but that doesn't mean anything. To me, those are the really important levels. 111.08 and 114.85. Either side of that, things will happen and should happen quite fast. I still think that this, what I wrote last week, is still very applicable. I think all positions, whichever way around, are likely to be tested next week. We have Powell and we have inflation numbers. I think people are going to get whipped in a thin summer market. Thank you very much indeed, and speak to you on Monday.